All right, today we're going to break down one of the most important ideas in the entire modern economy, the limited company. I mean, it is the absolute powerhouse behind almost everything we see. But how does it actually work, and what does it mean for the people who own a piece of it? So let's kick things off with a question that gets right to the point. Imagine you have this brilliant business idea. You're ready to go all in, but what happens if things go south? Could that dream you've poured everything into end up costing you your savings, your car, maybe even your house? For a lot of people starting out, that is a very, very real fear. You see, to really appreciate why the limited company is such a game changer, we first have to understand the problem it was designed to solve. So let's look at what happens when there's no separation at all between the business owner and the business itself. Okay, so if you're a sole trader, in the eyes of the law, you and your business are the exact same thing. This is called unlimited liability. And yeah, it is as scary as it sounds. It means if your business can't pay its bills, lenders can come after your personal stuff. We're talking your house, your car, everything is on the line. It's a massive gamble. So, how in the world do you protect yourself from that kind of risk? Well, this is where a truly revolutionary idea comes into play. The idea of creating a kind of financial shield by inventing a whole new type of legal person. And that brings us to the core concept, limited liability. The bottom line is pretty simple. If you own shares in a limited company, the absolute most you can ever lose is the amount you paid for those shares. That's it. Your personal assets, they're safe and sound, tucked away behind this financial shield. So how does this magic work? Well, the law literally treats a limited company as its own person, a totally separate legal entity. This means the company, not you, is the one signing contracts, owning property, and taking on debt. It's completely distinct from its owners, the shareholders. And this is why the structure is so incredibly popular. I mean, not only does it protect your personal wealth, but it also makes it so much easier to raise money. Think about it. Investors are way more willing to take a chance on a new idea when they know their potential loss is capped. This is the engine that lets small ideas grow into massive global corporations. Right, so how does a company actually get the money it needs to get started and to grow? Just think of the company as a giant pie. To get cash, it needs to sell off slices of that pie. That whole pie is what we call equity. It's the total value of the company that belongs to the owners. And as you can see, that equity really comes from two main places: the money you get from selling those slices, or shares, which is called share capital, and the profits that get reinvested back into the business, which are called reserves. But, and this is important, not all slices of the pie are created equal. You generally have two types: ordinary shares and preference shares. Ordinary shareholders are the true owners. They get voting rights and have the potential for huge returns, but they're also the last to get paid if things go wrong. Preference shareholders, on the other hand, are playing it a bit safer. They usually give up their voting rights in exchange for less risk. They get paid first with a fixed payout. It's that classic trade-off between control, risk, and reward. Now, selling off pieces of the pie isn't the only way to raise cash. Companies can also just borrow money by taking on debt. This is often done through something called debentures, which are basically long-term loans. The key difference here is crucial. With equity, you're selling ownership. With loan capital, you're just borrowing. The lenders are creditors, not owners. They don't get a share of the profits, but they must be paid their interest no matter what, even if the company isn't profitable. Okay, so let's say the company is up and running and it's successful. It's actually making a profit. Now the directors have a big question on their hands. What should we do with all this money? And they've really got two main options. Option A, they can pay out some of that profit to the shareholders. We call that a dividend. Or Option B, they can keep the money inside the company and reinvest it to help the business grow. That's what's known as retained earnings. And this is such a key takeaway. Paying dividends might make shareholders happy right now, but it's reinvesting those profits, retained earnings, that really fuels long-term success. It's the company quite literally betting on its own future. But all of this protection, this limited liability shield, it does come with a catch, a big one. You can't just operate in secret. A limited company has a duty to open up its books and show the world how it's doing financially. And the way they do this is by publishing annual financial statements. Honestly, the best way to think about these is it's the company's official report card. It gives investors, lenders, really anyone a clear snapshot of the company's financial health. Now, one of the most critical parts of that report card is the statement of financial position. And this slide just lays it out perfectly. On one side, you have everything the company owns, its assets, things like buildings, cash, machinery. On the other side, you have everyone who has a claim on those assets. That's the owners through equity and the lenders through liabilities. And here's the golden rule. These two sides must always, always balance. What a company owns has to equal the claims against it. So there it is. The limited company is this incredibly powerful shield that protects investors and fuels so much of our economy. But it leaves us with a final, really challenging question to think about. When a company, this legally separate person, causes widespread harm, who is truly responsible? Where does the buck actually stop? That's the complex, thorny question right at the heart of modern capitalism.